the question is in front of your screen, as you can easily I think it is visible to you, right? So the question says that you are a valuation expert, right? So this question is regarding valuation. So you are a valuation expert hired by a financial consultancy firm, right? Hired by a financial consultancy firm to evaluate three different business. So in front of you, three different business are there, and you have to evaluate them. So here is the first one, Company A. Company A, it is a tech startup, right? It has a promising software idea that is called IP. What is IP? IP is intellectual property. IP is, intellectual property, right? So IP means intellectual property, right? It has very few physical asset, no factory, no building, right? But huge potential to earn profit in the future. That is called high expected future earning. So this is about company A. Now, so similarly, we have company B, a 50-year-old real estate holding firm that own multiple commercial property. Right. Similarly, we have Company C, a retail business recently shut down due to losses, looking to liquidate its operation. So these are three different company. Company A is a tech startup, right? Company B is a 50-year-old real estate holding firm, and Company C is a retail business recently shut down due to loss. Now you are asked to recommend the most appropriate valuation approach for each. So let's look at the question. So first of all, which valuation approach would be most appropriate for company A? Right. Company A, I told you this is a tech company, right? And why? Option number A, cost approach, because the business has few tangible asset. Option B, market approach, because the software company are always valued based on the recent deal. Option C, income approach, because the company has high growth potential and future income stream. Option D, cost approach, because IP, that is intellectual property, needs to be valued at the fair market value, right? So this is the question. So you have to see, so, there are three approach: cost approach, market approach, income approach. So which approach is most beneficial for valuation of the tech company? That is the question, right? So tell me, do you know about all this approach? What is cost approach? What is market approach? What is the income approach? This is the starting point of unit number 13. If you go through unit number 13, the first thing that they have given is these three approach: cost approach, market approach, income approach. If you don't know, I will tell you, right, what it means. So let's get started. So basically, this tech startup, right? This tech startup. So you can guess also. Take the wild guess. See, let's see whether your guess is correct or not. Just guess and type the answer: A, B, C, or D. Right? Just by guessing, you can just type your answer. And let me explain what is the correct answer. So this particular tech startup, right? It does not own building. It does not own machinery. What it has is a big potential to earn a lot of money in the future. You can see now it is clearly written. Take a startup with a promising software intellectual property, right? It does not have a big company, big machinery, but it has a big potential, right, to earn a lot of money in the future. So instead of looking at what it on today, we value it based on how much money it might make tomorrow. So this is the key point. How much money, right? How much money it will make in future. It will make in future. So this is our basis of valuation. It will make in future, right? So this is our basis of valuation. And tell me which type of approach it is. Is it cost approach? Is it market approach? Or is it income approach? No, no, no. It is income approach, right? So it is called, income approach. Income approach, it always looks forward, right? So this income approach, you must know that this income approach always looks forward, right? It does not it does not look backward, because what we are looking at, how much money it will make in the future. Because this tech startup does not have a sound infrastructure, it does not have a huge machinery, but what it have is a good intellectual property, right? So we are looking at how much money it will make in the future, and that is what income approach does, right? So that is the point. So friends, the correct answer to this question is The correct answer to this question is what? Income approach, right? So let me ask you a question. Does it make sense to use an approach based on future income for a startup? Yes or no? Please answer. Suppose we have a startup. Suppose instead of this question is asking is about a startup. Suppose we have a startup. Does it make sense to use an approach based on future income? Yes or no? What do you think? For a startup, does it make sense to use an approach based on future income? Type yes if you agree or type no if you are unsure. So basically we have a startup. So does it make sense to value it based on its future income for a startup? What do you think? And basically future based on future and sub, and what will happen if we use the cost approach? What will happen if we use the cost approach, right? So will it show high or low value for this startup, right? So basically, let me tell you, what do you think? Which approach would be most beneficial? Yes, obviously, correct answer is yes. Because a startup has almost no physical asset today. A startup has no physical asset today, right? So using the cost approach would undervalue it, right? Cost approach will undervalue it because cost approach look at the asset that is present with the company right now. But since a startup does not have any physical asset right now, so cost approach will undervalue it, right? So that's why we will look at the future income for this startup, right? So this was our first example, right? So we have learned an important lesson is that we have to choose a valuation approach that reflect the true economic reality of the business, right? So I hope the concept is clear why income approach is best. If it is clear, just write clear in the chat box, right? You must know what is income approach, what is this cost approach, and what is this market approach, right? So market approach means what? Based on the market price rate, right? Income approach means what? You look at the future date, you look at the future value of this particular company. On that basis you decide. And what is the cost approach? It look at the present asset, right? So for this particular tech startup, income approach is the best way to go. So please tell me, is it clear? Is the concept clear? Please let me know in the chat box. क्या ये concept clear है? If it is clear, just write clear in the chat box, right? So for company A, which is the tech startup, income approach is the best approach to go through, right? Now friends, have a look at, if you want me to repeat it, I will repeat it again. For suppose a startup is there, some startup company is there, like this is a tech startup, right? It does not have any physical asset. Okay. So once again, I'm repeating. See what this question was all about. Let me explain. Some people have joined late. So this question was that suppose you are a valuation expert, right? And you have three company to value. Company A is a tech startup with a promising software intellectual property. It does not have any tangible asset and it has expected high future earning. Company B is a 50-year-old real estate that own multiple commercial property. And Company C is a retail business that shut down due to loss, looking to liquidate its operation. So these are the condition of three company. Now the question was which valuation approach would be most appropriate for Company A, which is the tech startup. Options are option A cost approach because the business has few tangible asset. Option B market approach because software company are always valued based on recent deal. Option C income approach because the company has high growth potential and future income stream. And option D cost approach because IP, that is intellectual property, needs to be valued at the fair market value. So friends, this is the question. So answer to this question is income approach. You must know what is cost approach, what is market approach, what is income approach. Why answer is income approach? Because this is a tech startup. It does not have any physical asset today, right? But what it has a supreme quality that it has huge future income generation. So we will use that, and this is nothing but income approach, right? It has huge future income, right? So huge prospect of future income is there. That's why income approach is the most suitable approach to go for valuation, right? Cost approach is not suitable because cost approach, if you use cost approach, then it will undervalue it, it will get undervalued because it does not have any physical asset right now. And if you go for market approach, so market approach tells you the current market price. But since it has just started, since it is a startup, so this market value is not that much, right? So that would not be appropriate. So the correct answer to this question is income approach. So I hope it is clear now. Now look at the next question. Question number 2. So the question is, if the cost approach were used to value company C, what is company C? A distressed retail firm. Which of the following is the biggest risk? I told you na, company C. Let us look at company C. What happened to company C? It is a retail business recently shut down due to losses, looking to liquidate its operation. It shut down due to loss and it is looking to liquidate its operation. This is the status of the company C, right? So company C is a retail business that recently shut down due to loss, right? So you might have seen a shop or a mall in your area suddenly shut down and put up to a too late board, right? Now the question is, let's come back to the question here. So this is the question. The question is, if we decide to value this business using the cost approach, what is the biggest risk? Let's go through the option. Option number A, overstating its potential market share. Option number B, undervaluing its intangible asset like brand name. Option number C, ignoring its actual operating income. Option number D, overestimating the business goodwill and synergy potential. So this is a very good question, that what will be the biggest risk if we use cost approach to value company C? These are the 4 options, right? What do you think? Is it A, B, C or D? See, let's simplify it. Think about it. When a business shut down, we might only look at the thing we can sell, right? What are the things we can sell? Like we might look at furniture. Suppose a business shut down, we look at the furniture, we look at the, we look at furniture, we look at stock, we look at equipment. These are the things that we look at whenever a business shut down, right? So obviously cost approach is all about the same thing. Cost approach, the cost approach mainly does the same thing. It add up the cost of all the physical stuff. Remember, cost approach is all about, physical item that this business has, right? It is all about the physical item. So now a business has shut down, we look at how much furniture it has, how much stock it has, how much equipment it has, and that is what cost approach does. But what we are missing here, are we missing something? Can you tell me what we are missing? Are we missing something here? Tell me, is there anything missing in this particular list? Furniture, stock, equipment? Yes, there is something missing. Can you point it out? What is missing here? So the main thing that is missing here, is the brand name. Yes, this is the brand name. This is missing. This, this is intangible asset. So these are tangible asset which we can touch. But this brand name, loyal customer, right? Loyal customer, or even the shop location reputation, right? So all these things are, intangible. This cannot be touched upon. These are intangible asset. So these intangible asset still have values, especially in a distressed sale, or if another company want to buy the brand, right? So tell me, cost approach give us the full picture of a distressed business, yes or no? I am asking you a question. Cost approach give us the full picture of the distressed business, yes or no? Tell me. Just answer yes or no. Is this statement correct or incorrect? Does cost approach gives you a full picture of the distressed business? What do you think? Just now I have explained you. Please tell me yes or no. Does cost approach tell you the full picture of the distressed business? True or false? What do you think? Because what we have seen, that yes, for tangible asset it is good, it can tell you that what is the actual cost of this tangible asset. But what about this intangible asset like brand name, loyal customer, location reputation? These are intangible asset. Can you quantify it? Can it be quantified using the cost approach? The answer is no, right? So cost approach does not gives you, the answer is no, it is false. Cost approach does not give you the full picture, especially when intangible assets are still worth something. In this case, brand name is there. In this case, loyal customer are there. In this case, location reputation is there. These things cannot be addressed by the cost approach. Because how can you quantify? Cost means what? Something that can be quantified. So you can't quantify this the cost of this intangible asset, right? So I hope the concept is clear that cost approach does not takes into consideration the intangible asset, and this is the biggest risk. Now can you tell me the answer? This is the biggest risk of this cost approach, right? It does not takes these intangible asset into consideration. Now I hope you are in position to answer this question. So would you agree that even a shut down retail brand might still have some value left in its customer base? Obviously it has, right? In distressed business we must be careful not to ignore the hidden value, especially in intangible asset like brand, like customer, right? Right. For example, you might have heard about, Nokia phone. So Nokia phone has a huge brand reputation. Still, it is not that much in market right now. But Nokia word itself has a brand value associated with it. Similarly, this particular company has a brand name, loyal customer, location, reputation. These are intangible asset, and these are not captured by the cost approach. Now, tell me what is the correct answer. What is the biggest risk if we use cost approach for a distressed retail firm? Overstating the potential market share, undervaluing it intangible asset like brand name, ignoring it actual operating income, overestimating the business goodwill and synergy potential. What do you think is the biggest risk? So the correct answer to this question is option number B. Right? I told you na that basically we are undervaluing its intangible asset like brand name. If we use the cost approach, we are basically undervaluing its intangible asset. Please tell me, is the concept clear or not? Right, you must be thorough with this cost approach. Yes, B is the correct answer. Very good. Right, you must be thorough with this term. What is cost approach? What is market approach? What is this income approach? So remember, for take a startup firm, income approach is the best way, right? So this is the answer. Now let's switch our focus to the next question, right? So this is the question before you, right? So let me zoom out a little bit. So let me explain what this question is all about. So basically we have, let me zoom a little bit, right? I hope it is visible now. I hope the video is clear now. Now, Steel Mill Limited, right? So so this is a manufacturing company. They are going through a financial restructuring. They are going through a financial restructuring, and here is the situation that happen quite often in the real world. Because their balance sheet, you see, their balance sheet shows some old value, right? You can see some asset were about 10 years, 15 years, 20 years ago. Some asset were about 10 year, 15 year, 20-year ago, right? But times have changed, price have changed, so the company want to show true updated value, not outdated book value, right? So they are using something called modified book value approach. Because the asset were about 10-year ago, 15-year ago, 20-year ago asset were about, but times have changed, so the price have also changed, so the company want to show true updated value, so they are using the approach called modified book value approach. So um, so let's look at this question. So first of all, what they purchase? They purchase land, right? They purchase land. As you can see, the first asset they have is the land, and the market, the book value of the land. They purchased land 50 year ago at 50 crore, right? And today the market value of the land is 200 crore, right? Now, the next is machinery. Book value of machinery, which was purchased 5 year old technology, 100 crore. Now, replacement cost is 150 crore and current resale value is 80 crore. Similarly, for inventory, which is the finished steel, book value is 30 crore, expected sale price is 40 crore, and selling cost is 5 crore. And receivable they have book value 20 crore. You know what is the meaning of receivable? Receivable means what? What you are expecting, some payment you are expecting from someone, that is called receivable. So book value of receivable is 20 crore and 10% estimated default risk. 10% chance is that those people who have taken credit from you, they will not pay you back. That is called default risk. So this is the situation. Let's look at the question. First question is, under the modified book value approach, what should be the adjusted value of steel mill land? So first of all, talk about the land. Let's look at the land. Options are 50 crore, 200 crore, 125 crore, 150 crore. So let's look at the land. First of all, question is all about the land, right? So uh, so tell me, before going through the question, let me ask you a question. Do you think that it is fair to show 15-year-old land at the price it was bought? Type yes if you think that old price are okay, or type no if you believe that it should reflect today's value. So my question is, do you think that is it fair to show 15-year-old land at the price it was bought? You see now, 50-year-old was bought at 50 crore. Is it fair to show 15-year-old land at the price it was bought? If yes or no, what do you think? So basically, in this case, the book value of this land was 50 crore and current market value of the land is 200 crore. And question is asking, under the modified book value approach, what should be the adjusted value of this land? 50 crore, 200 crore, 125 crore or 150 crore. These are the options, right? What do you think? Right, I told you that the data I have provided you, they have bought at 50 crore. This was the book value. 50 crore is the book value, and today the market value is 200 crore. Now the question is, what should be the adjusted value of the steel mill land? Is it 50 crore, 200 crore? What do you think? So let's break it down. First of all, the characteristics of land is that it does not wear out. Land does not wear out, right? There is no depreciation in the land. You don't need to replace land like you do with machine, right? You replace machine, but you don't replace the land. It just sit there and appreciate in value over the time. You know value very well. The value of land appreciate over the time. So under this approach, what is the approach? Modified book value approach. Under this approach, we say, let's show the true market value. What someone would pay for it today if the land were vacant and up for sale. Right. So tell me, which value would you use? Will you use the book value, or will you use the current market value? Right. Tell me, whether you will use the book value to adjust it under the modified book value approach, or will you use the current value, or will you use the average value or replacement cost? What do you think? So one answer I am getting is 200 crore. Okay, very good. So replacement cost is meaningless for land. Replacement cost has nothing to do for land, right? What matter is the current market price. This is what matter, right? So for land, we always look at the current market value, right? So suppose you bought a house 15 year ago at 30 lakh. Suppose you bought a house 15 year ago at 30 lakh, and suppose today it is still valued at 30 lakh. Would you be happy or sad? Tell me. So the question is, suppose you bought a house 15 year ago at 30 lakh and today the value is still 30 lakh. Obviously you would be sad, right? So it is the same concept. Even in company balance sheet, the same logic apply, right? In modified book value approach, land is always valued at the current market value because it does not lose value like a machine. That's why the correct answer to this question is option number B, that is 200 crore, right? So that is the case of the land. I hope the concept is clear. How do we deal with land in the case of modified book value approach? Please let me know. Just write clear in the chat box. Right. Why other options are incorrect? I just told you. Now, have a look at the second part of the question. The second part of the question is, how would the CFO value finished steel inventory under this approach? So let's come back to the finished steel inventory, right? So it's all about finished steel inventory. So let's look at the case. So here we have the inventory of finished steel. So book value they have given 30 crore, expected sale price is 40 crore, and selling cost they have given 5 crore, right? So these three value they have given. You know what is the selling cost? Like packaging cost, logistic cost, right? So how should the CFO value this inventory under the modified book value? So you have to use this data, right, to figure out. You have to use this data to figure out how should the CFO value this inventory under the modified book value approach? So let's come back to this question. Let's come back to the question. This is the question we have. Just wait a minute. Yeah, this is the question we have. Right. So let me show you the data. Let me write down the data here, because what was given. So book value, they have given inventory book value 30 crore. Right. Expected selling price. Expected selling price they have given 40 crore. And selling cost, right, packaging cost, transportation cost, they have given 5 crore. So what will be the valuation under the modified book value approach? Tell me, A, B, C, or D. What do you think? Is it 30 crore, 45 crore, 40 crore, and 25 crore? Right. So let me explain in the simplest way. Suppose, listen to my word very carefully, then only you will understand the concept. Suppose you are selling a car for 5 lakh. Suppose you are selling a car for 5 lakh. But to sell it, you need to fix a dent. There is a dent on the car. You need to repaint it. You need to repaint it. Right. And you need to pay the delivery charge. So these three charges you have to pay. First of all, you have to fix the dent on the car. You need to repaint it, and you need to pay the delivery charge. So it will be totally, it will cost 50,000. It will cost how much? 50,000. So tell me how much actually you will get in hand. So you will get 5 lakh minus 50,000. So it will be how much? 4.5 lakh. So that is your real value. That is your real value, right? Same idea here. Now can you tell me the answer? Because I have given you one example to understand the situation. Right. You have a car. You are selling it at 5 lakh. This is the selling price. There is a dent on it. You have to repaint it. Delivery charge. All that costs 50,000. So also out of 5 lakh, 50,000 is spent on this kind of repairing work. So almost the final value is 4.5 lakh. Now apply the concept here, which is the finished steel inventory, and tell me the answer. So that is the real money. The real money they are. So basically, what is happening here? So one answer I am getting is option number C. Let's see. So let's apply the concept here. What is happening here? The company hope to sell the steel for 40 crore. This is what they are hoping, 40 crore. But they have to spend 5 crore to package and deliver it. So the real money they will make is how much? 40 crore minus 5 crore, which is how much? 35 crore. So this is called, net realizable value. Sometimes question may be asked, what is the net realizable value? Right. So the net realizable value is the selling price minus the selling cost. So which is the correct answer is 35 crore. Very good. Option number C is the correct answer. Right. So if you show the full 40 crore in the book, even though 5 crore will go into the cost, this will overstate the value, right? This will overstate the value. So remember, whenever valuing inventory in the real life, don't just look at the selling price. Always subtract the cost to sell. That give you the real value. So the CFO is quite smart. They record the inventory at 35 crore, not 40 crore, not 30 crore. Please tell me, is the concept clear for these two questions? Right, very good. Correct answer is option number C. So we have learned how do we value the land and how do we value the inventory, right? Like this steel inventory. So please tell me, is the concept clear? Right. So this is called net realizable value, right? So remember, these kinds of inventory are always valuation is done at the net realizable value. Now have a look at the next question, right? I hope this was the simplest question. Let's look at this. Now we are discussing the stock and debt approach. So till now we were discussing the market adjusted rate approach, right? So these are the different kind of approach which we are discussing. So till now we were discussing the market risk adjusted approach. Now we will discuss the stock and debt approach. Let's have a look at this particular question. So let's talk about Ocean Tech, right? Ocean Tech Limited, and it is a tech company, right? It is a technological company being considered for acquisition. They are going for acquisition. The acquiring company want to use a stock and debt approach to value it, right? So some data have been given to you that the outstanding share is 20 lakh. For this company, outstanding share is 20 lakh. Current share price is rupees 75. Total debt outstanding is 25 crore. That is called, book value of the debt. And the market value of debt is 25.4 crore, 24.5 crore, right? So it is trading at slightly discount due to the favorable interest rate, right? Also, the stock has been volatile. It bounced between rupees 65 to rupees 85, right, in the past month. And some experts say that use the 30-day average stock price, that is 72, instead of the current price, that is 75. So this is the situation, right? So outstanding share given, total debt outstanding given, current share price is given, market value of debt is given, right? Some analysts say that you use rupees 72 instead of the current price rupees 75. Now have a look at the question. So the question is, what would you use to calculate the company value, right? If the oceanic valuation is calculated using the stock and debt approach with the current market price 75, what is the total enterprise value? Right. So what is the total enterprise value? This is what has been asked. Option A 40 crore, option B 39.5 crore, option C 38.5 crore, and option D 39.5 crore. So that is the question. So you have to find the enterprise value of this oceanic valuation company, right? Using the stock and debt approach. That is called enterprise value. So basically, let's come back to this particular question. Two things you are seeing, right? Two things you are seeing. The first thing, they have share. Share means equity, right? So they have raised money through equity, and outstanding share is 20 lakh, and also they have taken debt, right? So share is also there, debt is also there, and debt outstanding is 25 crore, right? So and market value of debt is given 24.5 crore. So you have to find the enterprise value. How to go about finding the enterprise value? It is very simple, right? So they have two sources of capital, right? First of all, debt, other is equity. So what you do, you find the market value of debt, you find the market value of debt, and you add it to the market value of equity, right? So you calculate them individually, you add them together, this will give you the total enterprise value. Now can you tell me what is the market value of equity based on the data? What is the market value of equity? How to find the market value of equity? Can anyone tell me what is the market value of equity that they have? See, how many shares they have? 20 lakh share they have. And what is the price of one share? Rupees 75. Just tell me, what is the market value of equity? Please let me know. Current share price means one share costs rupees 75, and outstanding share they have is 20 lakh, right? So what is the market value of equity? It is very simple. If you have calculator, please do the calculation and tell me the answer. It is very simple. So what you do, share outstanding multiplied by share price, this will give you the market value of equity. So what is share outstanding? Share outstanding is how much? 20 lakh share is outstanding. And what is the share price? Share price is rupees 75. So just multiply 20 lakh multiplied by 75. So this will give you 15 crore. So this 15 crore is the market value of equity. Now, what analyst is suggesting? That you use rupees 72, that is the 30-day average stock price, instead of rupees 75. Suppose I take share price rupees 72. Now tell me what will be the market value of equity then. So if you are taking 75, it is coming 15 crore. Suppose instead of this 75, I am taking 72. What will be the market value of equity? Very simple, 20 lakh multiplied by 72. So this will be approximately 14.4 crore, right? So presently we are not going to do that. We are sticking to 75. We are sticking to 75. 75 rupees per share, right? So what is the market value of equity? 15 crore. Tell me, is this clear or not? Yes, 150, yes, 15 crore is the correct answer. Yes. Now, what is the market value of debt? They have directly given 24.5 crore. They have directly given the market value of debt, which is nothing but 24.5 crore. Now, can you tell me the answer? Let's come back to the question. Now, can you tell me the answer? Is it A, B, C, or D? So what is the total enterprise value? That is what they have asked you, right? So this equity and debt, it gives us a full picture, right? So 15 crore value equity we have already calculated, and the market value of debt they have given is how much? How much is the market value of debt? It is 24.5 करोड़. आप यहाँ पे देख सकते हैं कि डेब्ट का जो मार्केट वैल्यू इन्होंने दे रखा है वो दे रखा है 24.5 करोड़. So what you will do? 24.5 crore, this is the market value of the debt, and 15 crore is the market value of equity. You just add both of them. So this will give you 39.5 crore. So what is the correct answer? Please tell me. So 15 crore equity, I think B and D both are correct here because both are repeated. Yes, B and D, I think both are correct. 39.5 crore, right? So correct answer is option number B or D. Both are correct. 39.5 crore is the correct answer. Is it clear or not? Please let me know. क्या ये concept clear है? Yes, I hope it is clear. How to find the enterprise value? What you do? You look, आपको enterprise value निकालना है तो आप देखिए ये जो particular company है, right? Where what are the capital structure we have? What are the source of capital it has? It has equity, it has debt. आप उसका market value निकालिए. Find the market value of debt. Find the market value of equity. Add both of them. This will give you the total enterprise value. And this is what we do under the stock and debt approach. This approach name you must know, stock and debt approach. So please tell me, is the concept clear or not? Right? How do we go about finding the the enterprise value? This is very simple. You have to just do little bit calculation and that's it. Right? So this is how we find the total enterprise value. 39.5 crore is the correct answer. Now friends, have a look at this particular question. Again, it is based on the same Ocean Tech technology, right? Let's see what happened now. So 75 we have just done, which is 39.5 crore answer we have got, right? Now have a look at this particular question. A rival analyst argue that Ocean Tech stock price is inflated due to short-term speculation and recommend using a 30-day enterprise price. So how would this impact the valuation? Tell me. Now instead of 75 rupees, suppose I take 72 rupees, right? So what will be the, how do you affect the valuation? Option number A, enterprise value decreased to 39.54 crore. Option number B, enterprise value decreased to 38.9 crore. Option number C, no change. Option number D, enterprise value increased due to reduced volatility. So this is a very good question. You will see the impact of, short-term speculation and using the 30-day average. So what will happen to the enterprise value? Very simple it is. We have to apply the mathematics. Right. So let's revisit the data. What were the data? Sorry friends. So shares outstanding. How much share outstanding? Just I'm writing here 20 lakh share were outstanding. Right. Now new price they have suggested. What is the new price suggested? They have suggested rupees 72. Earlier we take rupees 75. Now they are suggesting rupees 72. And the debt market value, it does not change with respect to the price. Debt market value they have given is 24.5 crore. Now can you do the calculation? Let's do the math. Right. So first of all, let's find the equity value. So what is the total enterprise value now? Equity value. So total number of share outstanding multiplied by price per share, which is nothing but 20 lakh multiplied by 72. Right. So how much it is? 20 lakh multiplied by 72 in terms of crore. Yes, very good evening. So in terms of crore, if you find the equity value 20 lakh multiplied by 72 rupees, this will be 14.4 crore, right? And what is the debt value they have given? What is the value of debt? They have given 24.5 crore. This is the debt value. So what will be the enterprise value? What will be the enterprise value? If you use rupees 72, this will be nothing but 14.4 plus 24.5. Just add both of them. How much you are getting? So tell me the correct answer. So just add both of them. I think you are getting 38.9 crore. Isn't it? Am I right? 38.9 crore is the correct answer. Please let me know. See what we have done. It is very simple thing what we have done, right? So what we did, very simple, that share outstanding 20 lakh multiplied by new price, which gives us 14.4 crore. This is the equity value. Debt value remain the same as it is, 24.5 crore. Just add both of them to get the enterprise value, which becomes 38.9 crore, right? So correct answer is option number B, right? Enterprise value decreased to 38.9 crore. Very good, right? So as you can see that compare what was the previous value in the previous question. In the previous question enterprise value was how much, 39.5 crore, and now you can see enterprise value is just 38.9 crore. So because we are using a slightly slower share price, the equity part is worthless, and that pull down the total value, right? So that is the point. You can think of it like, buying a house, but the last buyer may be overpaid. So you look at the average price of the past 30 days to avoid being fooled by the temporary hype. Same logic apply to the share. Using a 30-day average price give you a more balanced and often less risky estimate. So this is the advantage of using a 30-day average price. Suppose you are buying a house, right? What happened? Last buyer might be overpriced, might be overpaid. So you look at the average price of the 30-day to avoid being fooled by the temporary hype, right? So that is the advantage and power of average price in valuation. So valuation is not just about number; it's about using judgment, right? Valuation is about using judgment, when to trust the market, when to take a step back. That is all valuation is all about. And this question teaches us the same thing, that if we use the 30-day average price, our enterprise value get decreased. It might be overpriced, right? So while valuation, we must take judgment properly. That is the main thing. Now, friends, have a look at the next question. Right. So this is a completely new question. Let's try to understand the concept. So question is, as you can see on your screen. So basically, it is regarding Take Grow Limited reported the following financial for financial year 22-23-24. Right. EBIT, earning before interest and tax, they are given rupees 120. Right. 120 crore it is actually. Tax rate they have given 25%. Interest expense is 15 crore. Interest income is 5 crore. Net operating income is 10 crore. So these are the data. Right. Now the question they have asked, what is the Take Grow NOPLAT? What is NOPLAT? Net operating profit less adjusted tax. 90 crore, 97.5 crore, 105 crore, or 112.5 crore. Every data is in crore because it is written rupees in crore. Right. So question is NOPLAT. So do you think that when we calculate operating profit, we should include or not or ignore non-operating item like interest income? Please tell me. This interest income. This interest income is like non-operating item. Interest income is like non-operating item. So tell me, should we include it or should we ignore it while calculating operating profit? We want to calculate the operating profit. Should we include this interest income? So if we include it, just type include, or if we ignore it, just type ignore. Have you understood my question? My question is, we are interested to calculate the operating profit. Should we include non-operating item like interest income? If we include, yes or no, that is our question. And basically NOPLAT means what? Net operating profit. That is what we are interested in. Should we include this interest income or not? That is our question. What do you think? Just apply basic common sense. You can answer this question, right? We are focusing on NOPLAT. That is called net operating profit minus adjusted tax. That is the full form of NOPLAT, right? So, and two types of operations are there: core operation, non-core operation. And this interest income is the part of non-operating item. So should we include it or should we ignore it? Just type what do you think. So the correct answer is we ignore the interest. So the correct answer is we ignore it. We ignore the interest, which is a kind of non-operating income. All those extra thing which is non-operating income, we have to ignore it, because we want to know how the business is performing without any distraction. Operating income, it tells you how your business is performing, operating profit, right? So we don't want any kind of distraction, and this kind of interest income is causing a distraction. That's why we ignore it, right? So let's break down the calculation into two parts. We want to calculate NOPLAT, so let's break down the calculation into two parts. First of all, we have to calculate the taxes, right? Because in the full form itself, you have to add less the adjusted tax. So first of all, let's calculate the tax part, right? And how to calculate the tax on EBIT? Let's calculate the tax part first. How do we calculate it? So we will calculate tax as if the company has no debt. Assume that company is having no debt. It has not taken any debt. We assume that company has not taken any debt. It does not have any interest income, no side income. These things we are assuming. No debt, no interest income, and no side income. We are assuming it, right? And then we are calculating the tax. So what is EBIT? EBIT they have given is 120 crore. This is our EBIT. And what is the tax rate? 25%. Can you calculate the tax? Please tell me. Can you calculate the tax? Very easy, right? 120 crore is the earning before interest and tax rate is 25%. So this 25% will be levied on this 120 crore only, right? So what will be the tax on EBIT? The tax on EBIT, just do the calculation, very simple. The tax on EBIT is how much? It is just find the 25% of 120 crore. How much would you get? 25 crore, sorry, 25% of 120 crore. That means 1/4 of 120 crore, which is nothing but rupees 30 crore. So this is the tax on EBIT. Tax on earning before interest tax. Is everything okay? I'm not getting any response from your side. Please let me know. Are you understanding it or not? Right? Because first part we are calculating is tax. Right? So tax on what? EBIT. How much tax it is? 30 crore. Please let me know. Just write yes or okay. I will understand that yes, you are following me. Right? Now a question for you. If a company has no loan, if a company has no interest, would it still pay tax? Yes or no? Suppose company has no loan, company has no interest. Will it have to pay tax? Yes or no? Tell me. Suppose company has does not has taken any loan. Company has no interest to pay. So does it have to pay tax? What do you think? Type yes if you think that company will have to pay tax, or type no if you think that company will not have to pay the tax. The correct answer is, just type okay, yes, obviously yes. That is the idea behind the NOPLAT, right? So let's pretend NOPLAT say that, let's pretend there is no interest, there is no investment, just operation. What would be the profit after tax then? So NOPLAT assume that, let's assume that there is no investment. Company has not done any investment. Company has not taken any debt. So no interest is there. So what would be, just operation is going on. Just operation is going on. So what would be the profit? So step number 1 we have done. Now step number 2 is to calculate the NOPLAT. So what is NOPLAT? It is very simple. What is the NOPLAT? It is just your EBIT, which is your earning, and minus tax. That is your NOPLAT. So what is EBIT we have? How much EBIT we have? It is 120 crore. So 120 crore minus tax. How much tax we have paid? 30 crore. 30 crore we have paid. Right. So the answer will be 90 crore. This is NOPLAT. Right. It does not take interest income. It does not take interest expense into consideration. Right. So what will be the correct answer? Correct answer is option number A. Right. So that is the answer. Now let's test your understanding. Suppose EBIT was 100 crore. Suppose EBIT was 100 crore. and suppose tax rate is 30%. Now can you tell me what will be the NOPLAT? Just do the calculation. Please let me know. Suppose EBIT is 100 crore, tax rate is 30%. Can you calculate the NOPLAT? 90. Okay, one answer I am getting is 90. Okay, 90 crore is the answer to this question. Now answer this question. Suppose 100 crore is the EBIT, tax rate is 30%. What will be the NOPLAT? Yes, very good. 70 crore will be the NOPLAT. Awesome. Right. I hope the concept is clear. So you can think of EBIT as the total profit your business made before paying interest and tax. Now NOPLAT just asks you how much profit is left after paying the tax, assuming no loan, no interest income. Why this important? Because it tells us true profit from running the business, nothing else. Right? So please tell me, do you feel now confident calculating NOPLAT? I hope you feel. Right? So remember what to ignore? What we ignore? We ignore the interest expense. We ignore the interest income. Right? While calculating the NOPLAT. Just take EBIT, find tax on it, subtract it, and that's it. That will be your NOPLAT. Right? So the answer is, 90 crore is the correct answer. Okay. So now have a look at this particular question. So this is one more question before you, as you can see on your screen, right? Uh, so this is a real world example of Lala industry, right? The same example has been taken from your book. In your book also same example has been given, right? So this will clear your concept. So Lala industry is, it is a mid-size manufacturing company. It is a mid-size manufacturing company, right? Their finance team wants to check how efficiently the core business is doing over the year from 2018-19 to 21-22. Right. So they have two key number. OIC. What is OIC? OIC is operating. OIC is operating invested capital. OIC is operating invested capital. Right. So this shows how much is invested in the core operation. Operating invested capital means how much is invested in the core operation, and every data is in crore. Like you can see in 2018-19, 219 crore was invested in the core operation. In 2019-20, 214 crore was invested in the core operation. In 2020-2021, 229 crore was invested in the core operation. In 21-22, 239 crore was invested in the core operation. Similarly, we have EBIT. I think you are familiar with EBIT. And finally, we have NOPLAT, which shows the profit from this core operation after tax. Right. Now, some detail has also been given, like marginal tax rate they have given 30%. Right. Now, let's look at the question. Have a look at the question. Let me show you the question here. Just wait a minute. Yeah. So the question is, why does NOPLAT exclude interest income and non-operating income in its calculation? Option A, to focus solely on core business profitability by removing financing and peripheral activity. Option B, because interest income is taxed at lower rate than EBIT. Option C, to comply with Indian accounting standard. Option D, because these items are the part of OIC. Very simplest question. I think we have already answered it. What do you think? Why NOPLAT exclude interest income and non-operating income in its calculation? Right? What do you think? Is it A, B, C, or D? So imagine that you own a bakery and you are calculating your profit. So your core business is what? Baking and selling the cake. But you might also have interest income from a bank or non-operating income from selling old oven. Now those are not related to the actual baking, right? So NOPLAT focus only on your core business performance, ignoring financial cost and any extra income. Why does that? What do you think? I think we have answered this question, right? Let me check whether you remember it or not. Why NOPLAT exclude interest income and non-operating income? Is it A, is it B, C, or D? What do you think? No answer I'm getting. I think you know it very well, right? Is it A, B, C, or D? Yes, the answer is option number A, right? The answer is option number A, because it want to focus solely on the core business profitability. it want to remove financing and peripheral activity cost, right? So by removing this non-core item, so there are two things. One is called core item and other is called non-core item. So by removing this non-core item, right, we get a clear picture of how well the core operation of the business are doing, right? That is the point. So remember, what is the formula for NOPLT? The formula for NOPLT is very simple: operating profit minus taxes on operating profit. That's it, right? Minus taxes on operating profit, right? Just it. So operating profit may be your EBIT, right? It may be possible that it is EBIT. We don't want to include things that are not related to the core business. I hope the concept is clear. Please type clear in the chat box. Let me check if it is clear to you or not. I think NOPLT concept is clear now. Is it clear? Please let me know. NOPLT, right? Okay, very good. Now have a look at the next question. In the same example, if the Lala industry 21-22 operating invested capital included 20 crore of excess cash, which is non-operating, what would be the adjusted OIC for evaluating the core operation? Right, that is the question. So means what should we do with this excess cash? Right. So option number A, 239 crore, means no adjustments is required, means keep the OIC as it is and make no change. Option number B, 219 crore, that is subtract 20 crore from OIC to adjust for the non-operating cash. Option number C, 259 crore, that you add 20 crore to OIC since we want to increase the capital. And option D, 229 crore, right? Use the OIC value from 2021 data. Let's come back to this data, right? This data we are talking about, this particular table. You see this 21-22, right? So basically what happened that when you are evaluating a company core operation, extra excess cash become. How much excess cash? 20 crore excess cash. How do we deal with it, right? So when you are evaluating a company core operation, excess cash is not part of that because it is not being used for daily business operation, right? So it's like having a saving account that is not being actively used to run the bakery, right? So what should we do with the excess cash? And its present OIC is 239 crore. So how should this excess cash affect the OIC, affect the operating invested capital? That is what is being asked, right? So what do you think? What do you think? What will happen to the OIC? Whether it will remain the same, it will get decreased, it will get increased, or what? So let me tell you, this excess cash is considered a part of non-operating. This excess cash is a part of non-operating, right? Because it is not a part of the core business operation. It is just sitting there, not being used to drive the business forward, right? So what we need to do? And what is this OIC? OIC is the operating invested capital, right? So this is not driving the business forward, right? So this is so tell me, what should we do with the excess cash? Should we subtract it? Should we add it, or should we let it be as it is? So the correct answer to this question is, we should subtract it, right? This should be subtracted, right? So what is OIC? What is OIC? OIC, the formula of OIC is the operating asset, right? Operating asset plus operating working capital. Operating working capital. Excess cash is called non-operating because it is not part of the core business. So we need to subtract that excess cash to get adjusted OIC. Now, how to get the adjusted OIC? So adjusted OIC will be how much? Present OIC. What is the present OIC? 239 crore. You can see now the present OIC is how much? The present OIC is 239 crore. It has given in the table, right? So 239 crore minus 20 crore. So 239 minus 20. This will give you 219 crore, right? So this 219 crore is the correct answer. So you can think of it like this. Suppose there is a bakery. I am giving you one example to understand. Suppose there is a bakery, right? This bakery has rupees 1 lakh. This bakery has rupees 1 lakh saved up in the bank account that is not being used to buy new equipment, ingredient, or pay for staff. It is just sitting there as cash. This cash does not help the bakery daily operation, right? It's like having extra saving in your bank that is not being used for running the business. So to get the real picture of how much money is being used for baking cake, we subtract that excess cash from the bakery operating capital. So this gives us the adjusted OIC, right? So I hope the concept is clear that if company has excess cash, it should be excluded from the net operating invested capital. That is called OIC, right? So I hope why the answer is 219 crore. Is it clear, right? I think it is clear now that why we have to subtract, because this cash is just sitting idle. It is not helping the company in its operation. So it is not operating. That's why we have subtracted it. So two things we have learned in these two questions is that what is NOPLAT, right? While calculating NOPLAT, remember we did not take interest income, non-interest income into consideration. And second thing is what is OIC and how to deal with this excess cash, right? The same thing is given in your book. So remember, OIC measure how much capital the company is using to run the business. If there is any extra cash lying around and not being used for the business purpose, we remove it to get a more accurate picture, right, of how much money the company is really using, right? So that is all about these two questions. So I hope the previous question NOPLT concept and OIC concept is clear, right? Now have a look at this particular question. So in this question, this is the simplest one, right? This is the simplest one from unit number 12, right? So the question is, the company has received an order for three product P, product Q, product R, right? So there is an order for three product, but here is a twist. The twist is that some product are in stock while other need to be bought at the current market price, right? So company has in existing inventory for some product while other needs to be purchased. So some product are there in the stock while other needs to be bought at the current market price, right? So some details they have provided you, right? For product P, no inventory is there. You must buy all unit at the current market price. For product Q, it has some old inventory that can either be used for the order or sold at a lower price. Additional unit must be purchased if the order is accepted. And product R, it has old inventory purchased at a higher price, but the current market price is lower. So these are the three conditions, right? Now let's look at the question. The question is the company has 120 units. Let's look at the product Q. The company has 120 units of product Q for now in the inventory. How many? 120 units of product Q in the inventory, right? But the customer need 200 unit, right? But the customer need 200 unit. The inventory was purchased. It was purchased at rupees 18 per unit. But now the company can either sell them for rupees 14 rupees per unit or use them for the special order. If the order is accepted, the company must buy additional 80 unit at rupees 20 per unit, right? So the question is, what should we consider while deciding the relevant cost? So here the concept is relevant cost. What is the relevant cost of product Q in this decision, right? So these are the four options. So basically the question revolve around relevant cost, right? So 120 units are there with the company, 200 units is required, right? 200 units is required. So order can be accepted or order can be rejected. If the order is rejected, the inventory can be sold for rupees 14 per unit. And if the order is accepted, right, then extra 80 units company has to purchase at 20 rupees per unit. So what is the relevant cost for product Q in this decision, right? So basically this question is regarding decision making, unit number 12. Remember, in decision making, we only care about relevant cost. What is the meaning of relevant cost? Relevant cost means that cost that will actually affect the decision. Those costs that will affect the decision are called relevant cost. So historical cost are called sunk cost. I think we have already discussed this concept, right? There is something called, sunk cost, sunk, 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 right? Sunk cost means what? Some irrelevant. Sunk cost is all, remember, sunk cost is irrelevant for the decision, and historical cost is a kind of sunk cost, right? Because they don't impact the future outcome. Now, in this case, what is relevant? Tell me, what is relevant here? The company can use the existing inventory or sell it. Either they use the existing inventory or they sell it, right? If they sell it, they get 14 rupees per unit, right? Try to understand this word. Very, very important thing I am telling you using an example. So suppose the company sell it. So if they sell it, they get rupees 14 per unit. And this is called, opportunity cost. This is called opportunity cost. Why it is called opportunity cost? It is called opportunity cost because this is an opportunity when company loses by, what the company loses by using the inventory for the order instead of selling it, right? So if the order get rejected, this 14 rupees per unit is the opportunity cost. And suppose the order get accepted, then the company need to buy the additional unit, which is 80 unit, at how much? Current market price of 20 rupees per unit. So this is called incremental cost. This is called incremental cost. So what are the relevant cost here? Tell me whether this 18 rupees per unit is relevant cost or not. Yes or no? Yeah. Tell me, is this 18 rupees per unit relevant cost or not? Is this a part of relevant cost? Yes or no? What do you think? Is this 18 rupees per unit part of this relevant cost? What do you think? The answer is no, right? 18 rupees per unit is a part of historical cost, and historical cost is called sunk cost. It is irrelevant. So we have to figure out what is relevant cost here. Two relevant costs are here. First is the opportunity cost, and second is the incremental cost. Now let's calculate individually. First opportunity cost, and then let's calculate the incremental cost. Can you calculate the opportunity cost? How much is the opportunity cost here? Can you calculate it? Right. Opportunity cost is how much? Opportunity cost for how much? 120 units. Right. So how much is the opportunity cost? Very simple. Let me calculate it. Let me write down opportunity cost. So opportunity cost is how much? How many units are there? 120 units are there. Suppose the order gets rejected. So the company has to sell this 120 unit at rupees 14 per unit. Right. So this is the opportunity cost, which will be how much? 120 multiplied by 14 will be 1680. Right. So this is the opportunity cost. And what is the incremental cost? So when incremental cost will come into picture? When the order get accepted. So if the order get accepted, the company order is for 200 unit. Company has only 120 units. So they have to purchase 80 units. And at which cost they have to purchase? 20 rupees per unit. So what is the incremental cost? 80 multiplied by 20, which is how much? 1600. So these two are relevant cost. Remember, in decision making, we have to decide what is relevant cost. So what is the total relevant cost? Can you do the calculation? What is the total relevant cost here? Total relevant cost is how much? 1680 plus 1600. This is how much? 3280. Right. So which is the correct answer? Option number B is the correct answer. Right. Option number B is the correct answer. So opportunity cost means what? If we sell the inventory, we get rupees 14 rupees per unit. So we lose. So why it is called opportunity cost? Because we are losing. Right. We are losing. Right. So we are losing 1680 rupees. And incremental cost, to fulfill the order, we need to buy 80 more unit at 20 rupees each, which will cost 1600. So these are relevant costs because they directly affect the decision to accept or reject the order. And the historical cost of 18 rupees per unit is irrelevant, right? It is a sunk cost that does not affect the future decision. Please tell me, is the concept clear? How do we decide the relevant cost, right? So which one to take in relevant cost? Historical cost, remember, do not take historical cost as relevant cost. We can take opportunity cost and incremental cost as the relevant cost, right? So that is the point. Now, one question for you, similar question for you. Now, let's look at it. For product R, so product Q we have done. For product R, the company has 80 units in inventory, purchased at 25 rupees per unit. Current market price is 20 rupees per unit, and customer need 100 unit. So what would be considered in the relevant cost calculation? That is for product number R. Right, 80 units of product are in inventory, bought at 25 rupees per unit. Customer need 100 unit, right? So the company has to decide whether to use the existing inventory or to buy more unit to fulfill the order, right? So what cost should the company consider to make the decision? Think carefully, right? So what cost? Can you calculate the relevant cost here? Very easy question, right? So tell me whether this 25 rupees per unit will be considered in relevant costing or not. Tell me, is this 25 rupees per unit, will that be considered in relevant costing? Yes or no? The answer is no. Why? Because this is historical cost. This was the cost at which this was bought. This product R was bought, purchased. It has no relevance right now, right? So it is called sunk cost, historical cost, or it is called sunk cost, right? So what is the relevant cost here? Relevant cost is the current market price, which is how much? 20 rupees per unit. Because you see it has 80 unit and the company it customer need 100 unit, so it has to buy extra 20 unit, right? So tell me, what is the final answer? What is the relevant cost here? Very easy question, right? What will be the relevant cost here? So extra 20 unit, right? And what is the price at which it has to be bought? So the relevant cost for 100 unit will be how much? 100 multiplied by 100 multiplied by how much? 20, right? Which is the current market price, which is how much? 2000, right? So this 2000 rupees, right, is the relevant cost. Option number A is the correct answer. It is the current market price because the company would need to buy more unit at 20 rupees per unit to fulfill the order, right? So 100 multiplied by 20, that will be the 2000. So this will be the relevant cost, right? So friends, I hope today we have discussed a lot of questions. Some more questions are also there. We will cover them in the next lecture, right? So we have started. Let me just remind you what we have done today. So we have started with the first question on we talked about cost approach, market approach, and income approach. I told you for a startup company, we always use the income approach. The second question we discussed, it was regarding the distressed retail firm, in which I told you intangible asset is also taken into consideration, like brand name, loyalty, customer, location, reputation. And this is one of the disadvantage of cost approach. It does not take all these things into consideration. Then we discussed about how to value the land. I told you the land is always valued at the current market value. And also we discussed one question: how do we value the inventory, which is the finished steel, right? I told you that it is always done. We always have to subtract the selling cost. Some packaging cost, logistic cost has to be subtracted. This method is called modified book value approach, right? This we have discussed. Then after we discussed, the next thing is regarding the stock and debt approach, calculating the enterprise value, right? How do we calculate the enterprise value? Market value of debt, market value of equity. This thing we have done. Enterprise, that is called a stock and debt approach. And then we have talked about NOPLAT, that is called net operating profit less adjusted tax. I told you while calculating NOPLAT, interest expense, interest income has not been taken into consideration. Just take EBIT, just subtract the tax, and then operating invested capital. And I told you that whenever excess cash is there, we have to subtract it from the to get the adjusted OIC. Then after we just relevant cost. In relevant cost, remember sunk cost has not to be taken into consideration. What is sunk cost? Sunk cost means historical cost, means the price at which the product was bought. You don't have taken into consideration. And besides leaving that, every cost has some value like opportunity cost, incremental cost. Based on that, we decide the relevant cost. So friends, I hope today's session was useful for you, right? We have discussed some important concept, right? So basically, if you go through your Macmillan book, you will see the same thing. Every example have been taken